All I'm saying, folks, is before making any big investing decisions, maybe get a second opinion beyond that real estate agent and a former magician. YouTube is so weird. Hey Bowtie Nation, Joseph Hoger, thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week, stocks I'm watching, economic news, the good guy of the week. Very important video for you this week. YouTubers are again screaming for the imminent collapse of the US dollar with videos that would be comical if they weren't scaring investors into bad decisions. Videos titled, "It's Over, China Just Broke the US Dollar," and my favorite, "The End of America," are clickbaiting investors into rushing into investments that will ultimately go nowhere. I try to tell myself, don't hate the player, hate the game, right? Because I've met a lot of these guys. I know Graham and Kevin from an influencers conference that we all go to. Andre seems like a good guy, but I just hate that YouTube only rewards the most sensational videos and ideas, even if it's to the harm of viewers. So before you sell all your dollars for Chinese yuan, we're going to look at where the dollar is as the reserve currency, where it might be heading, and how to invest for that. Stick around though, because after that, we're going to look at stocks to watch this week, as well as the economic news, the trends, and the strategies you need to see. Now, clickbait aside, the loss of reserve status for the US dollar would be a monumental shift and something you would need to plan for. It would mean extremely higher rates, higher inflation, and just a lower economic well-being for Americans. Now, I don't want to get too bogged down in what a reserve currency is or the history behind this, because I know you don't care. I just want to start everyone off on the same page, and then we'll talk about the facts behind this and how to invest. Now, the dollar became the world's reserve currency after the Bretton Woods Agreement in 1944. It was there that governments agreed to, instead of each holding massive amounts of gold to back their own currencies, they would just hold US dollars to stabilize their foreign exchange rates, right? At the time, the US was linked to gold. The US had massive amounts of gold to stabilize its own currency, stabilize the dollars. So it was thought that as other countries held massive amounts of dollars, it would be just as good as that gold-backed system for those other currencies. And that status as a reserve currency gives the US enormous monetary power. Okay, that constant demand for dollars just means lower interest rates for government borrowing. It also means better access to capital for US companies with those foreign investors always ready to snap up that dollar-denominated bonds or stocks. Even when the US stopped backing its own currency by gold in 1971, the dollar kept that reserve status. Of course, other countries would love to get a piece of that reserve status. They're always trying to get their hands on our lucky charms. In his video, Andre does spend some time admitting that de-dollarization fears go at least as far back as the 70s, but then he goes on to quote Ray Dalio, which has been screaming about the end of the dollar for more than a decade. Dalio continues to argue that just because former currency regimes from France and Great Britain that have lasted about 100 years, that means the current near 100-year dominance of the US dollar is destined to end soon, as if it's a time shift change rather than those long-term macroeconomic forces. Now, of course, the big news lately is talks about the BRIC nations, Brazil, Russia, India, and China trying to de-dollarize a part of their reserves and strengthen their own currencies. Because yeah, these four countries have a clue about how to run an economy. Brazil, which shifts back and forth from capitalism to socialism so often I've lost track, has defaulted on its debt 7 times in the last 100 years, most recently in 1990, and has a currency that has lost 60% of its value due to 6% average inflation over the last decade. Of course, Russia just narrowly avoided a default last year and saw inflation rise to 18% on its botched invasion of Ukraine. It's only China and India here that have any semblance of economic stability, and both have serious problems with state control and corruption. Folks, it comes down to this. The reason the US dollar has maintained its reserve status for so long is not because some shadowy petrodollar deal, as some YouTubers would have you think, but that rule of law, trust in institutions, and economic stability in America. And you can laugh at that statement all you want, but try living in another country, as I have for more than 10 years, and you see that it really is true. The level of systemic corruption, informality of law, the breakdown in the judicial system, and just the general instability in many parts of the world do not make for a good reserve currency. And while news reports love to sensationalize the idea that demand for dollars from foreign central banks has hit a 25-year low, it hides the fact that it's only been a 10% change from 70% of Forex reserve holdings in the greenback just to 60% today. You see this chart, the blue here, outpacing all others by far from 1999, goes from about 70% to 60%. We're going to look more detailed in these numbers, but that is only a 10% change in the foreign currency holdings of the US in 25 years. In fact, I downloaded this chart from the IMF, the International Monetary Fund, on the world currency composition of reserve holdings. You can see down here the share of allocated reserves to US dollars, euro, renminbi, Japanese yen, all the way down there from 2009 all the way to the most current 2022. And you can see that the foreign reserves of holdings of US dollars has only fallen about 3% over the last decade, from about 61% in 2013. We've got about 62% here in 2009, down to 58% here just most recently in 2022. The next most held currency here, the euro, has gone from 27.7 down to 20%. So it seems a lot of the shift from foreign reserve holdings hasn't come from the dollar, but has come from some of these other currencies like the euro. And of course, the big question mark, the Chinese renminbi, which is supposed to be the alternative to that dollar reserve currency, has only increased its reserve status from about 1% holdings in 2016 to about 2.7% last year, which is hardly a shift in dominance. We see here a chart of the US dollar index, which is like a price chart of the value of the dollar against a basket of major currencies. And the US dollar continues to be that go-to currency during uncertainty and hit a 20-year high against those other currencies just last year. So nation, if you just look at the facts here, if the dollar is losing its reserve status, it is going to take a very long time. At this rate, it could take 30 plus years for dollar holdings to fall to even 50% as a percentage of those total foreign reserves, which would still be currency reserve status. Of course, it's probably going to happen slightly faster than that, but it's still going to be so slow as to be imperceptible to 99% of the investors out there. Even someone in their 20s with 30 plus years to invest are not likely to see the economic effects of that de-dollarization. That means the best way to invest continues to be just buying US stocks for the long term. A chart here of the sector correlations with the US dollar. So this shows how stocks in each sector of the economy tend to move as far as price returns with the US dollar, and they're all negatively correlated with the greenback. Now that means a weaker dollar tends to come with higher stock prices. Okay, it's mostly because the dollar tends to rise during times of uncertainty while stocks fall, and vice versa. But it also has to do with the fact that many companies have overseas earnings that become more profitable when stronger foreign currencies are translated into weaker dollars. And of course, you can always shift your exposure to stocks with this higher negative correlation with the US dollar. That's going to mean if the dollar does weaken faster, then you're going to make more money because these stocks tend to go up in price as the dollar weakens further. You got a negative 0.4 correlation here in healthcare. So a lot of drug stocks, a lot of biotech stocks, materials here, negative 0.398 to the US dollar. Of course, those are going to be a lot of your miners, a lot of commodities. We're going to talk about commodities and energy next. Consumer discretionary. Those are going to be a lot of companies that have profits overseas. Like we talked about, those stronger foreign currencies, if the dollar does weaken, are going to mean higher profits for those stocks in the consumer discretionary sector. Now, if you're still worried about that sudden collapse in the dollar, then just a diversified mix of a lot of inflation-proof assets is also going to make sense, since commodities like oil, gold, and metals are priced in dollars. As the dollar weakens, those assets are going to rise in price. Okay, we tend to think of oil at $100 a barrel, gold $2,000 an ounce. So as the value of the dollar comes down, then those commodities keep their value and rise in price. Also make sure you have some exposure to real estate exposure, so REITs, real estate investment trusts, as well as direct property holdings. That's going to help you fight inflation as well as a weakening dollar, but just don't get scared into making any rash decisions with your investments, folks. Now I want to highlight some of the stocks I'm watching this week. Going to be a huge week for earnings. A lot of companies reporting their first quarter profits. First up here is Teladoc Health, ticker TDOC. It's going to be reporting its earnings on Wednesday, with the market expecting a loss of 51 cents a share on a 9.5% sales growth for the quarter. Our shares are up about 9% since announcing that the company was going to be expanding its telehealth services into weight management and diabetes prevention earlier last month, a growth market including those weight loss drugs. Management has taken 3 of the last 4 quarters here to report giant impairments to the balance sheet. That caused earnings to miss big time all 3 of those quarters. Wednesday could be an opportunity for management to actually talk up its sales growth and the market opportunity in that new weight loss segment. So I'm thinking it could be potentially to send the shares higher. I'm also watching Meta Platforms here, ticker META, the old Facebook, reports its earnings on Wednesday after the stock has surged 140% since that October low. Shares are back up to a relatively expensive 21.7 times this year's expected earnings. So, that's on revenue growth, only expected up about 5% this year before rebounding next year. The stock just, the rally seems to be completely on the back of those layoff announcements and really the hope that those lower operating expenses due to staffing changes are going to help drive profitability. Now, the operating margin here, so that main metric of operating profit, is down from 30% in the first quarter of last year to just 20% in the fourth quarter. I do expect that to come up with some of these with these layoffs and operating expenses changes, but with no sign of a bottom in ad rates, the stock just appears to be priced to perfection and might not get it. Now, I do hold shares of Facebook Meta here at a cost basis of $110. I bought them last year, but have sold covered calls against those at $220 a share just to cover some of the near-term downside risk. Medical Properties Trust, ticker MPW. It's going to report its earnings on Thursday, with shares rebounding 16% since March on really some progress with issues to its two top tenants. Okay, the healthcare REIT took an impairment charge on Prospect rents earlier this year and then announced the sale of some Steward hospitals in Utah that should help de-risk the portfolio slightly from these two tenants. MPW also announced a sale of its HealthScope portfolio in Australia that's going to help prepay debt through 2024. So, positive progress aside, I do think there is a good chance we see a dividend cut. I do expect it Thursday if we do get one. But as I reviewed in a video last month, there is no need for a cut on this as those funds from operations, the FFO, do cover the dividend. But management may just want to play conservative on this and pay down its debt. I would still expect the shares to pay at least 80 cents a share for that dividend, and which would be a great 10% yield, and I'd be a buyer on any dip in these share prices. Also here, Gaming and Leisure Properties, ticker GLPI. It's expected to report its earnings on Thursday. This is one of the few REITs out there that is positive over the last year. REITs have just plunged on those higher interest rates, with the overall industry down 25% over the last year, but GLPI is still benefiting from really a post-pandemic rebound in gambling and tourism. It makes it one of my favorite dividend REITs right now. It pays a 5.5% yield. Wrapping up the week on Friday is NIO reporting its earnings after a plunge of 13% last week. Stock initially reacted favorably to strong economic data out of China, but then fell on those multiple price cuts from Tesla. Okay, so Tesla is really forcing a price war in electric vehicles right now. Originally, the CEO of NIO told CNBC in an interview that the company would not match those price cuts. It might be a smart strategy here, though, and help protect that profitability, which is really why shares of Tesla are plunging here, because investors are just worried about that profitability as it cuts prices. Deliveries for NIO were up 32% last year, are expected to keep up that pace even in a slowdown. Boyd, ticker BYD, is already the low-cost producer in China, with some of its models priced as low as a quarter of the price for NIO EV models. So it'd be difficult to compete on that low-price strategy anyway. NIO has that battery switching technology that's unique to NIO models, gives it that selling advantage, and could help sales even as those others cut their prices. We did see 6 of the 11 stock sectors close higher last week, with really weak cash flow on AT&T's earnings and broad weakness in online stocks hitting the communication services sector. The plunge in price on oil hit oil stocks, while banks did continue to rally as fears around that banking crisis fade. Stocks in the financial sector are now down just 2.9% for the year and still pretty attractive on a valuation basis. Click on the video to the right for the one dividend stock in each sector I'm buying for my perfect dividend portfolio. 11 dividend stocks that will always pay your bills. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.